A quick disclaimer, this video is for education purposes only. Forex involves a high risk reward and a high risk business, and you should not trade with money that you cannot afford to lose. This channel serves as an education purposes and not as an advice to buy or trade in Forex instrument. See the description below in this video for full disclaimer. Welcome to FX Newpip, and this will be our 5th lesson in beginner course. In this lesson 5, I will cover what is margin explanation, and what are the types of margin available in Forex broker. Let's get started. Before we dive in further into Forex margin, let's recap on leverage. Leverage is important as margin, therefore we cannot forget how leverage works. To recap, leverage is where your initial deposit times by the amount of borrowed funds provided by your Forex broker. For example, if your initial deposit is $100 with a leverage of 100, you are able to trade a size worth of $10,000. However, that doesn't mean you can open up a few standard lots at one time, because your account has its maximum limit to open up a trade position, and that is called margin. Margin allows trader to open leverage trading position and trade the market with just a smaller trading capital. However, margin, same like leverage, can be a double-edged sword as it magnifies both profit and losses. Margin also available in stock trading. For example, investor can use margin accounts when buying stocks, and the margin allows them to leverage borrowed money to control a larger position in shares. In Forex, it works the same. Usually, it requires 1 to 10% of the position size. However, margin requirements differ depending on Forex broker and the region of your account is based in. Like in the UK, margin requirement usually start at around 3.3% for major currency pairs like Euro USD, USD JPY, etc. If you forget what are the major currency pairs, please refer back to lesson 1. What is Forex trading? Margin has its own formula. The formula for margin is margin level is equivalent to equity divided by use margin times by 100. Let's assume your Forex broker offers a margin rate of 3.3% and you place a position worth of $10,000. Only $330 is required as deposit to enter the trade. The remaining of 96.7% or margin will be provided by your broker. As your trade size increases, the amount of margin is required. I will cover this more on the next slide. Imagine margin is like your gas tank. The more gas you have, the longer the journey you can go. If you look at this chart, this is we term as the margin level chart. On the left is the danger zone, which marked in red color. The zone is also called margin call zone, meaning when a trader account capital doesn't have enough margin to sustain their open position, their account will turn into red. This can be caused from opening too many positions. Many call this scenario as account burst, or no longer can trade and is out of the business. If a trader account is in between 50 to 100% area, this is where a trader needs to be careful with their margin, because please don't forget, Forex is a high volatility market. Beyond 100% area, or as you can see the green area, your account is safe. So remember, margin is like your gas tank meter. When it reaches red, you need to be careful with it. Let's have a look at an example how to calculate required margins. In this slide, I will show an example of margin calculation for safe zone. For this, we will use an example if your account is denominated in US dollar with a leverage of 100, and assume you just started, so your balance will be $10,000. Meaning to say your initial capital is $100 with a leverage of 100, you will have $10,000. Assume margin required for Euro USD is 2% and you decided to buy 2 standard lot. Remember standard lot? One standard lot is equivalent to 100,000 units of currency, or equivalent to $10 per pip. So if 2 standard lot is 200,000 and times 1.3000 the quote, which will bring us a total of $260,000. 2% from $260,000 is equivalent to $5,200, and this is the required margin from your account. Now position is open, and to know where your margin level is, you need to take $10,000 of your balance, divide by $5,200 and times 100, which will bring us to 192%. Refer to the right chart, that is where your margin level is. It is still in the safe zone. However, the best advice is to maintain it at the zoning of 200% and above. This is because if your open position goes against you, at least you will have a buffer margin to maintain your open position. In this slide, we will use the same account size but with more standard lots. This time, with the same account, we will use it to buy 6 standard lots at the cost of 1.3000, which will bring us a total value of $780,000. 2% out from $780,000 is $15,600, and this is the required margin. Position is open and repeat the same calculation, and your margin level is at 64%. This zone is considered alert zone. When it reaches to 30% zone, some forex broker will automatically close your position. In this slide, we will go through how much margin is required by your forex broker before you place a trade. In other terms, the margin that will be locked by your forex broker when you open a trade. Scenario 1, we will use a leverage of 1 to 100 and assume we trade with standard lot. Assume you trade 10 standard lots, which is equivalent to 1 million units of currency. The formula is to take 1 million unit of currency and divide it by the leverage you are given. In this case, is 100. The answer is $10,000. When you place trade 10 standard lots, means your broker will lock $10,000 from your equity. In scenario 2, let's assume you have a leverage of 1 to 100 and you deposited $1,000. Assume you trade 5 mini lots and each mini lot is equivalent to 10,000 units of currency or $1 per pip. So you will trade 50,000 units of currency. Take 50,000 units of currency, divide by 100 your account leverage, that will bring us to $500, and forex broker will lock this margin in your account for this trade. Remember, your initial deposit is $1,000. Your forex broker have locked $500 from your equity, and now you are left with $500 as your new account balance. This account balance is called usable or free margin. Before we finish this lesson, let's look at other margin jargons that are commonly used in forex trading. First, it is use margin. Use margin is the margin that you already used up, which is locked by your forex broker. For example, if your account size is $1,000 and you have 2 open positions, which is one is USD JPY that use up $300, and the second one is GBP USD, which use up $500, and total from these 2 positions is $800. Your account are left with $200. This $200 is called free margin. Margin call is when your account falls below the minimum amount required to maintain or open a new position. Remember slide 3, the graph or thermometer of your margin? When it falls under the alert zone, please be careful. To recap, margin and leverage are related but they have a different meanings. When you start with forex trading, you will find your available margin at the bottom of the MT4 or MT5. Or you can use margin calculator that is available online. Thank you. If my Forex education channel helps you in your Forex trading journey, please remember to click subscribe and also select the bell icon to get notified every time I post a new education video. Please share this channel to your friend if you find it useful, and let's together we impact a million lives.